Chapter 3, and we're just going to do an overview. If you guys want to turn some lights off, feel free. So, Chapter 2 is what I meant to say. Chapter 3 we may do Chapter 2, PowerPoint. So we're talking about combinations. When two companies come together because one purchases another, and there's various methods in which these combinations can occur. We're going to talk about them. So combinations basically happen for various reasons. Sometimes because it's the best way of growth without having to grow internally. You just purchase another company and grow. And there are other times when they want to enter a new market sector, and what a better way to do it than purchasing another company. I believe Microsoft has recently purchased Skype. So basically, Microsoft is trying to get into another avenue of the internet. Now, the codification sections that deal with this, if those of you who really want to read more, 805 and 810 deal with the combinations and consolidations. The primary method we need to use now is the acquisition method. We need to be familiar with the other ones, but that's where we're going to spend our time. So you can see that in this day and age, combinations are purchases of other companies. We call them mergers, acquisitions. They are happening at a rampant rate, and oftentimes, as you can see with some of these, they purchase sector or companies within their sector just to eliminate competition. And then we're starting to see more of crossing sectors to expand their various markets. So vertical integration is basically a way to just purchase up the competition. And oftentimes there's many departments that overlap. And so they can basically eliminate some of the departments, such as HR, in that when they combine some of those departments that are currently being utilized in both companies can be combined in one company. So basically, and there's various types which we're going to talk about, but when we combine companies, what we're talking about in this chapter is related to the financial statements. Even when two companies are still operating independently, for financial purposes, we have to report a consolidated financial statement. So that's the crux of this chapter, is discussing how we go about combining the financial statements to a consolidated financial statement. Now, it depends based on what type of consolidation or combination happens. And as this says, why do we need to consolidate it? Well, remember, the whole purpose of the principles of financial statements is that an entity is reported on its own. When there's a combination, it's still a single entity. It's under the control of specific shareholders. So it's most appropriate to consolidate those financial statements to see what that entity presents as a whole instead of keeping them separate. Now, there are times when there's a combination, but each company keeps its own identity, but we still know they're combined for purposes of financial reporting. So we then have to take each of their separate financial statements and find a way to combine them together. So we can't necessarily have two sets of stockholders' equity being combined. So what we generally have to do is with the subsidiary company, we need to eliminate their stockholders' equity and flow them into the parent company. So we're going to go through some understanding, and then the best way is just problem after problem after problem. At least that's how it works for me. So business combinations are the event. It's the event that occurs when one person, we call them an acquirer, gets control over another business. There's different ways in which combinations can occur. So there are times when you take a company, the acquirer purchases another company, and they dissolve one of the companies, such as what Delta did with Northwest, and they operate under one company in itself. There are other times when one company, so that would be like a statutory merger, where the assets and the liabilities are acquired, and one company is totally dissolved, and the acquirer retains the name, like Delta. Now, there are times when through a statutory merger, they acquire all the stocks and they transfer all the assets and liabilities into a totally new company. So basically, there's a totally new entity that's created, and both the original companies get dissolved. Then we have situations where the stock, at least 50+% gets acquired as an investment, and even though it stays in existence, we still have to show consolidated financial statements on the companies together. And then, well, those are the main ones we're going to talk about. So combinations where one company purchases another, they dissolve one company, and they use the acquirer's company. Another type of merger where the assets all get transferred into an entirely new company. And then a situation where the companies, one company that is acquired, they continue to operate independently of each other with two separate sets of financial statements, but for purposes of reporting, we have to consolidate those to show one entity. So, in the case when dissolution occurs, like Northwest, the account balances truly get consolidated into the acquirer's financial statements. But in the case when they still are operating separately, then the financial statement information basically gets consolidated. And when there is ultimately what's called a permanent consolidation that occurs, this chapter talks about when we consolidate at the combination date. Chapter 3 is going to host a whole new set of problems when the consolidation occurs after the acquisition date. So chapter 2 is really focusing on how do we do this when we consolidate as of the acquisition of another company. Now, if separate incorporation is maintained, then basically what happens is separate accounting financial statements occur, or accounting processes occur on both companies. But then we, through a worksheet, have to combine them for reporting to the external users. So we're going to have several different problems based on the type of combination that occurs. Now, the interesting thing with this method we're going to use, called the acquisition method, and you guys are seeing this more and more as you advance in accounting. It used to be, like I'm teaching a Principles 1 right now, historical cost, historical cost. Everything is based on historical cost. That's what the financial statements report, apart from maybe some marketable securities. With this acquisition method, we're getting more involved in fair values of companies. So when the consolidation happens, if you think about it, if they're purchasing another company, generally we purchase a company at the fair value of what the company's, the various assets of what they're worth. Make sense? So we are going to use fair values for much of what we're bringing into the company. The company that is getting dissolved, we will report those assets we are acquiring from the new company and the liabilities at current fair values instead of historical cost principle. Do you guys know what I'm talking about when I say that? The historical cost principle is we report on our books what we actually purchase something for. Okay? Now, when we consolidate financial statements and we dissolve a company, we're going to determine the breakdown of what we're purchasing this company for. We're going to come up with the fair values because, again, we don't purchase based on old historical cost, do we? We purchase based on current values. So some of these buildings around here, no offense, but some of them are pretty old. So what Augsburg purchased them for might be, you know, a couple $100,000, and then with all the depreciation, their adjusted basis might be sitting even at $50,000, $100,000. But based on appreciation, if someone wanted to come in and buy sections of this place, they would have to buy them for probably $3-4 million. So purchases are based on what the going rate is. And so we need to estimate based on all the assets we're buying how we're going to combine it and consolidate it. So basically, excuse me, the acquisition method that we're going to use for this consolidation process takes into account the fair value in measuring the acquirer, the one who's purchasing it, the acquirer's interest in the business. Applying the acquisition method basically involves the consideration transferred for the acquired business, and then we separately identify the assets we're acquiring minus the liabilities we're assuming, and the difference is going to be either goodwill or it's going to be a gain because we got it for a deal. So, as you know in accounting, companies that create their own patents generally cannot show as an asset a patent, because if it's within their own departments of research and development, those costs have to be expensed as a current period cost. What happens, how patents are recorded as an asset, is because a company goes out and purchases a patent from another company. Then we can show an asset as a patent. The same is true with goodwill. We can't on our own generate goodwill, we're worth X, but when a company goes and purchases another company, and then we determine all the fair value of the assets, and after we've taken into account all those assets, we still have $200,000 sitting, that would be goodwill. Why would we purchase a company for more than what the fair value of the physical assets are? Because there's an intrinsic benefit within that company that then we record as goodwill. That makes sense? So, basically what we're going to do is discuss how fair value is basically that a company would receive to sell an asset in an orderly transaction between market participants. So this is at an arm's length transaction. What would someone really buy this for, and what are we going to accept it for is really the fair value of an asset. Generally, when we're dealing with fair value, we're dealing with two independent people. They aren't related parties, because sometimes with a related party, you're going to be more apt to give them a deal.